I've been watching something unfold in the markets that reminds me of every bubble I've witnessed in my 70-plus years of investing. The numbers are staggering, the excitement is infectious, and the danger is real. Right now, Berkshire Hathaway is holding over $325 billion in cash and Treasury bills. That's the largest cash position we've ever had in our history. And people keep asking me the same question, Warren, why aren't you buying anything? Don't you see the opportunities in artificial intelligence? Don't you see the innovation happening all around us? Well, let me tell you what I do see. I see stock valuations that have climbed to levels we haven't witnessed since the late 1990s. I see the total value of the U.S. stock market sitting at roughly 200% of GDP. The last time we were at these levels was right before the dot-com crash wiped out trillions of dollars of wealth. I see companies with sky-high valuations trading at price to sales ratios that would have been laughable just a few years ago. And here's what really concerns me. While I'm selling stocks and building up cash, retail investors are doing the exact opposite. Margin debt has surged back toward all-time highs. People are borrowing money to buy stocks at prices I consider expensive. They're using leverage, options, and every form of financial engineering you can imagine to amplify their bets. Just this past year, I sold nearly 2/3 of our Apple position. Now, think about that for a moment. Apple is one of the finest businesses in the world. It's a company with over 1 billion loyal customers. It generates more free cash flow than almost any company on earth. I've said publicly that it's probably the best business I've ever seen. And yet, I sold most of our shares. Why would I do that? Because price matters. At a certain valuation, even the best business in the world becomes a bad investment. And right now, with the overall market where it is, with valuations stretched as thin as I've seen them in decades, the prudent thing to do is to be cautious. But caution isn't popular right now. What's popular is the narrative that we're in the early stages of an artificial intelligence revolution that will change everything. That traditional valuation metrics don't matter anymore. That we need to think differently about how we value companies in this new era. You know what? I've heard all this before. Before I tell you why this worries me so much, let me be fair. Let me show you exactly what the bulls are seeing. Because there are smart people on the other side of this trade. Very smart people. And they've got some compelling arguments. The case for why we're not in a bubble right now actually sounds pretty good if you listen to it. The optimists will tell you that artificial intelligence represents the biggest technological shift since the internet itself, maybe bigger. They'll point to companies like NVIDIA, whose chips are powering this entire revolution. They'll show you how cloud computing giants are spending hundreds of billions of dollars building out AI infrastructure. How every major corporation in America is scrambling to integrate AI into their operations. And you know what? They're not wrong about the technology. AI is real. The advances we're seeing in machine learning and large language models are genuinely impressive. I've seen demonstrations that would have seemed like science fiction just a few years ago. Computers that can write, reason, and solve complex problems in ways that legitimately surprised even the engineers who built them. The bulls will tell you to look at the revenue growth. Companies at the center of the AI boom are posting quarterly results that show massive demand. NVIDIA's revenue grew from $27 billion in fiscal 2023 to over $60 billion in fiscal 2024. That's not hype. That's real money flowing from real customers willing to pay real prices for these chips. They'll point out that this isn't like the dot-com era, where companies with no revenue and no path to profitability were going public and soaring to billion-dollar valuations. The companies leading this rally are profitable. They have real earnings. Microsoft, Google, Amazon, Meta, these aren't speculative startups. They're cash-generating machines with established business models. The optimists will show you the productivity gains. They'll tell you that AI is going to make workers more efficient, reduce costs, and create entirely new categories of products and services that don't exist yet. That the economic value creation over the next decade could be measured in the trillions of dollars. McKinsey published research suggesting AI could add $13 trillion to global economic output by 2030. Goldman Sachs talked about $7 trillion in value creation. And here's where it gets really compelling. They'll argue that we're still in the early innings, that AI adoption is just beginning, that the infrastructure being built today will power applications we can't even imagine yet. Remember, the internet boom and bust happened, but then the internet actually did change the world. Amazon survived and became one of the most valuable companies on earth. Google didn't even exist during the first internet bubble, and it became a $1 trillion business. Maybe the same thing will happen with AI. The bulls will show you the investment commitments. Microsoft is planning to spend over $80 billion on AI infrastructure in fiscal 2025 alone. Google, Amazon, and Meta are collectively spending well over $100 billion more. This isn't speculative money. These are established companies with disciplined management teams making calculated bets with their shareholders' capital. They'll point to the competitive dynamics. If you're a major tech company and you don't invest heavily in AI right now, you risk being left behind. It's not optional, it's existential. So these investments make sense from a strategic perspective, even if the returns aren't immediate. And perhaps most convincingly, they'll tell you that this time really is different in one important way. The companies driving this boom have fortress balance sheets. Apple has over $60 billion in net cash. Microsoft, Google, and Meta all have enormous cash reserves and generate tens of billions in free cash flow every year. These companies can afford to make big bets. They're not going to go bankrupt if AI takes longer to pay off than expected. The institutional investors are buying too. It's not just retail speculation. Sovereign wealth funds, pension funds, and the most sophisticated investors in the world are adding exposure to AI-related stocks. Are all of these professional investors wrong? Are they all missing something that Warren Buffett sees? The bulls will remind you that you've been skeptical of technology before Warren. You missed Amazon. You missed Google. You were late to Apple. Maybe you're missing this one too. Maybe the world has changed in ways that your value investing framework can't fully capture. Now, all of that sounds pretty good, doesn't it? The technology is real. The companies are profitable. The investment is massive. The potential is enormous. Smart people with good track records are buying. If you just looked at those arguments in isolation, you'd think I was crazy for sitting on the sidelines. But here's the problem. Every single argument I just laid out could have been made about the internet in 1999. And I mean every single one. The technology was real. The companies were growing revenue. Smart people were investing. The potential seemed limitless. And you know what happened? The NASDAQ crashed by 78% over the next 2.5 years. Trillions of dollars in wealth simply vanished. So let me ask you something. Stop me if you've heard this one before. Revolutionary technology, massive investment, smart people saying traditional valuation metrics don't apply, retail investors pouring in, stock prices rising so fast that missing out feels more painful than the risk of losing money. In my 70 years of investing, I've seen this pattern repeat over and over again. The details change. The technology changes. The names change. But the fundamental dynamics are always the same. And they always end the same way, too. Let me tell you what concerns me most. It's not the technology. AI is real, and it will be important. It's not the companies. Many of these businesses will survive and thrive. What concerns me is the price people are paying for these expectations. See, there's a big difference between a great company and a great investment. A great investment requires buying a great company at a sensible price. And right now, I don't see many sensible prices. Let me walk you through how I think about this because it's important. When I look at any investment, I ask myself a simple question. If I bought this asset today and couldn't sell it for 20 years, what would it produce for me? If I buy a farm in Nebraska, I can calculate what it will produce. I know roughly how many bushels of corn or soybeans that land will generate each year. I can estimate the expenses. I can figure out the net cash flow I'll receive over those 20 years. The farm will keep producing whether the stock market is open or closed, whether people are optimistic or pessimistic, whether interest rates are high or low. The farm just keeps producing crops. If I buy an apartment building, same thing every month. Tenants pay rent. I have expenses to maintain the property. But I can calculate the net cash flow I'll receive over 20 years. The building keeps producing rental income year after year. If I buy shares in Coca-Cola, the company keeps selling beverages. It keeps generating profits. It keeps paying dividends. Over 20 years, I can estimate how much cash will flow to me as a shareholder based on the company's earnings power. These are what I call productive assets. They produce something of value. They generate cash flow. Their value comes from what they create, not from what the next person will pay for them. Now, let me ask you this. If you bought shares in a company trading at 60 times earnings, and you couldn't sell those shares for 20 years, what would you actually receive? Well, if the company earns its current level of profit every year for 20 years, and you own it for that entire period, you'd get back roughly 1/3 of what you paid. You'd need the company to triple its earnings just to justify the price you paid today. And that's assuming it pays out all those earnings as dividends, which most tech companies don't do. But here's the real question. What are the odds that a company currently trading at 60 times earnings will triple its profits over the next 20 years? Some will. Most won't. History is pretty clear on this point. The median price to earnings ratio for the S&P 500 over the past 50 years has been around 16. That means at normal valuations, you're paying $16 for every dollar of annual earnings. At 60 times earnings, you're paying $60 for that same dollar of earnings. You're paying nearly 4 times what stocks have historically cost relative to their earnings power. Now, the bulls will tell you these aren't normal companies. They're growing faster. They have better margins. They have network effects and moats. And sometimes that's true. But even the best businesses eventually face competition, maturity, and the mathematical reality that you can't grow faster than the economy forever. Let me give you a concrete example. In 1999, Cisco Systems was one of the most admired companies in the world. It made the routers and switches that powered the internet. It was growing revenue at 40% per year. It had incredible margins. Everyone needed its products. At its peak, Cisco traded at over 120 times earnings and had a market capitalization of $550 billion. It was one of the most valuable companies on earth. And you know what? Cisco was actually a great business. It still is. The company is still around today, still profitable, still paying dividends. But if you bought Cisco at the peak in March 2000, you'd still be underwater today, 25 years later, even including all the dividends. The business succeeded. The stock never recovered because the price people paid had nothing to do with the value the business could create. That's what I mean when I say price matters. It doesn't matter how great the business is if you pay too much. Now, you might think we've learned our lesson from the dot-com crash. You might think investors today are more sophisticated, more careful, more focused on fundamentals, but then you see the numbers. The total market capitalization of U.S. stocks is currently around 200% of GDP. We've only been at this level twice before in modern history. Once in 1999, right before the dot-com crash, and once in 2021, right before the market fell by 25%. The median stock in the S&P 500 is trading at a price to sales ratio that's near all-time highs, not price to earnings, price to sales. We're paying record prices for each dollar of revenue before you even subtract the costs of running the business. The so-called Magnificent Seven tech stocks, Apple, Microsoft, Google, Amazon, Meta, NVIDIA, and Tesla now represent over 30% of the total value of the S&P 500. That's the highest concentration we've seen since the early 1970s, when the Nifty 50 stocks dominated the market. And if you remember your history, you know how that ended. Margin debt, money borrowed to buy stocks, has climbed back above $800 billion. People aren't just investing their own money. They're borrowing to buy more at these prices. Recent market data shows that retail trading activity as a percentage of total volume is back near the levels we saw in 2020 and 2021 during the meme stock frenzy. Individual investors aren't being cautious. They're all in. And here's something that really caught my attention. The number of companies going public with valuations over $1 billion despite never having turned a profit, has been climbing steadily. We're not quite at dot-com levels yet, but we're heading in that direction. Options trading volume has exploded. Retail investors are buying short-dated call options, essentially making leverage bets that stocks will keep rising. When options activity gets this speculative, it's usually a sign that we're near a top. The ratio of stock prices to corporate profits, the aggregate price to earnings ratio of the market, is sitting around 20, 5 times earnings. That's roughly 50% above the long-term historical average. We're not in the most expensive territory ever, but we're in the top 10% of historical valuations. Corporate profit margins are near all-time highs. Now that might sound good, but here's the thing. Margins are mean reverting. When they're record highs, they tend to come down. When they come down, earnings fall. When earnings fall while valuations are already expensive, stock prices tend to fall a lot. The forward revenue growth estimates that analysts are baking into stock prices assume these companies will continue growing at close to double-digit rates for years to come. But we're already at full employment. We're already at high GDP. Where exactly is all this growth going to come from? I've seen estimates suggesting that to justify current valuations, the companies at the center of the AI boom need to generate something like $600 billion in annual AI-related revenue within the next few years. That's $600 billion in new revenue from AI alone. To put that in perspective, that's roughly the entire annual revenue of the U.S. pharmaceutical industry. Do people really think AI is going to generate that much monetizable value that quickly? And here's what nobody wants to talk about. The companies spending the most on AI infrastructure are the same companies whose stock prices have soared the most. Microsoft, Google, Amazon, and Meta are collectively spending over $200 billion per year on capital expenditures, much of it for AI infrastructure. That's money going out the door today based on revenue they hope to generate tomorrow. What happens if that revenue comes in slower than expected? What happens if competition drives down the prices they can charge for AI services? Now let me show you exactly how this ends, because I've seen it before. There are a few ways this could play out, and none of them are pleasant for people buying at current prices. The first scenario is the slow burn. The companies continue investing heavily in AI. Some of the applications start working. Some revenue materializes, but it comes in slower than expected. The returns on all this capital spending are lower than hoped. Earnings growth disappoints. Maybe the companies still grow at 5 or 8% per year, which would actually be pretty good for mature tech giants. But that's not enough to justify current valuations. So stock prices gradually drift lower over several years as reality catches up with expectations. This is what happened to Cisco and many other dot-com survivors. The businesses did okay. The stocks never recovered because people paid too much. The second scenario is the profit squeeze. Competition in AI heats up. Every tech company has access to similar models and similar infrastructure. They start competing on price. What looked like a high-margin business becomes a commodity. We've seen this pattern before in technology. Memory chips, hard drives, personal computers, they all started as high-margin businesses and ended up as low-margin commodities once competition intensified. If AI follows that path, the companies investing hundreds of billions today might find themselves in a brutal price war tomorrow. Margins compress, earnings fall. Stock prices fall harder. The third scenario is the interest rate shock. The Federal Reserve has cut rates recently, but they're still watching inflation. If inflation picks back up, rates might need to rise again. Higher interest rates hit expensive growth stocks particularly hard because those stocks are essentially long-duration assets. Their value comes from profits expected many years in the future. When you discount those future profits at a higher rate, the present value falls. Stocks trading at 60 times earnings could easily fall 30 or 40% just from rates moving up a couple percentage points. The fourth scenario, and the one that worries me most, is the recognition moment. That's when the market collectively wakes up and realizes that valuations have gotten way ahead of fundamentals. This is what happened in April 2000. There wasn't a specific catalyst. There wasn't a recession yet. Companies were still growing. But investors suddenly looked at the prices they were paying and realized they didn't make sense. Once that recognition spreads, the selling feeds on itself. People rush for the exits. Stocks that were up 200% in a year can fall 70% in months. I'm not predicting exactly when this will happen. I never try to predict short-term market movements. But I can tell you what I'm doing. I'm selling, not buying. I'm building cash, not deploying it. And there's a reason for that. So what should you do? Let me ask you some honest questions, and I want you to answer them truthfully to yourself, not to me. First, do you really understand the business you're investing in? Can you explain how it makes money? Can you estimate what its earnings will be in 5 years? If you're buying a stock because everyone else is buying it, or because the chart looks good, or because you're afraid of missing out, that's not investing. That's speculating. And speculation works wonderfully until it doesn't. Second, what's your margin of safety? If the company's earnings come in 20 or 30% lower than expected, is there still value at the price you're paying? Or are you entirely dependent on everything going right? When I invest, I want a margin of safety. I want to buy at a price where even if things go moderately wrong, I'll still be okay. Third, what would you do if the stock fell 50%? Would you buy more? Would you sell? Would you panic? If you don't know the answer to that question before you buy, you shouldn't be buying. I only invest when I'm comfortable holding through a major decline. In fact, I get excited about declines because they give me a chance to buy more at better prices. Fourth, are you using leverage? Are you borrowing money to buy stocks? If so, stop. Right now, I've seen more people destroyed by leverage than by bad investment decisions. You can survive a bad investment. You might not survive a bad investment made with borrowed money when the market turns against you. Here's what I'm doing, and you can take it or leave it. I'm holding cash, more cash than I've ever held. I'm not earning much on it. Treasury bills yield around 4 or 5%. That's not exciting, but it's safe. And more importantly, it means I'll have the capital to invest when prices become more reasonable. I'm selling stocks that have run up to valuations I can't justify. Even good companies, even companies I like. because price matters. I'd rather sell too early and miss some gains than hold too long and ride them all the way back down. I'm staying in my circle of competence. I don't fully understand AI. I don't know how to value companies whose primary asset is cutting-edge technology that might be obsolete in 3 years. So I'm not investing in them, no matter how exciting the story sounds. And I'm being patient. This is the hardest part. Watching stocks go up while you're sitting in cash is painful. Watching everyone else make money while you're being cautious feels terrible. But I've learned over 70 years that patience is one of the most valuable qualities an investor can have. The market will give you opportunities. You don't have to swing at every pitch. Charlie Munger used to tell me that the big money is not in the buying and selling, but in the waiting. He was right. The investors who do well over time aren't the ones who are most active. They're the ones who wait for the right opportunities and then act decisively when they come. Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. This isn't just a cute saying, it's the foundation of everything I do. If you lose 50% of your capital, you need to make 100% just to get back to even. It's much harder to recover from losses than people realize. So the first priority is always to protect your capital. Right now, with valuations where they are, protecting capital means being cautious. It means being willing to hold cash even though it's boring. It means being willing to miss out on some gains if that's what it takes to avoid major losses. I can't tell you exactly when this market will turn. I can't tell you if it's going to be next month, next year, or 3 years from now. What I can tell you is that trees don't grow to the sky. Valuations matter. And when the tide eventually goes out, we'll see who's been swimming naked. When this AI bubble finally bursts, and it will burst, just like every bubble before it, there will be tremendous opportunities. Great companies will be on sale at reasonable prices. That's when I'll deploy this cash. That's when Berkshire will be aggressive. But that time isn't now. In the meantime, I'm going to keep doing what I've always done. Looking for businesses I understand, run by people I trust, selling at prices that make sense. And if I can't find those opportunities, I'm perfectly happy to wait. The market is designed to transfer money from the impatient to the patient. Right now, a lot of impatient people are buying stocks at prices that don't make sense because they're afraid of missing out. Eventually, that money will transfer to the people who are patient enough to wait for better prices. I've been at this for over 7 decades. I've seen bubbles in commodities, in conglomerates and savings and loans, in emerging markets, in dot-com stocks, in housing, in cryptocurrencies, and now in artificial intelligence. The details are always different. The underlying psychology is always the same. People get excited. They bid up prices. They convince themselves that this time is different. And then reality eventually reasserts itself. You don't have to participate in every bull market. You don't have to own what everyone else is buying. You don't have to fear missing out. What you need to do is protect your capital, stay rational, and be ready when opportunities present themselves at sensible prices. That's what I'm doing. That's what I've always done. And it's worked out pretty well so far. The question is, what are you going to do? Because here's what I want you to understand. This isn't just about making money or losing money in the stock market. This is about your financial future, your retirement, your kids' education, your peace of mind. And right now, I'm watching people make decisions that could haunt them for decades. You know what keeps me up at night? It's not Berkshire's performance. It's not whether we're missing out on some rally. It's thinking about the teacher in Ohio who might be putting her retirement savings into stocks at these prices. The young couple in Texas borrowing against their home to buy more shares because they're afraid of missing out. The retiree in Florida who's shifting from bonds into stocks because cash feels like it's earning nothing. These are real people making real decisions that will affect the rest of their lives. And many of them are doing it based on the belief that stocks only go up, that we're in a new era where traditional valuation metrics don't matter, that they need to be aggressive or they'll be left behind. Let me tell you something I've learned. The most expensive words in investing are, "This time is different." Every generation thinks their situation is unique. Every bubble has a narrative that explains why the old rules don't apply. And every single time, the old rules do apply. Eventually, I remember sitting in my office during the dot-com boom. People would come to me with internet stocks trading at 200 times sales, not earnings, sales. And they'd show me projections about how fast these companies were going to grow, how the internet was going to change everything, how I was missing the biggest opportunity of my lifetime. And you know what? They were half right. The internet did change everything, but that didn't mean you should pay any price to own a piece of it. Most of those companies went bankrupt. The ones that survived took years to grow into their valuations. And the people who bought at the peak waited decades to get their money back. Some are still waiting. I stayed on the sidelines during most of that boom. People thought I'd lost my touch. Business magazines ran articles questioning whether value investing was dead, whether Warren Buffett was past his prime, whether the game had changed and I just couldn't see it. Then the market crashed. And suddenly everyone wanted to know my secret. But there was no secret. I just stuck to my principles. I refused to pay prices that didn't make sense. I was willing to look foolish in the short term to be right in the long term. That's the position I'm in again right now. Except this time, the stakes might be even higher. Because this time, it's not just dot-com stocks, it's the entire market. The S&P 500, the NASDAQ, everything is trading at valuations that assume almost perfect conditions for years to come. Think about what has to go right for current prices to make sense. Corporate profit margins need to stay at record highs. They can't mean revert like they always have in the past. Revenue growth needs to stay strong even though we're already at full employment and capacity in most industries. Interest rates need to stay low enough that expensive growth stocks remain attractive. Competition needs to stay rational. No major companies can stumble. No new technologies can disrupt the current leaders. The economy needs to avoid recession. Inflation needs to stay under control, but growth needs to stay strong. That's a lot of things that need to go right simultaneously. And history suggests that when you need everything to go right, something usually goes wrong. Now, I want to be clear about something. I'm not saying you should sell everything and hide under your bed. I'm not predicting a crash next month or next year. What I am saying is that when valuations are this stretched, the risk-reward ratio is terrible. You're taking enormous risk for modest potential returns. Let me put some numbers on that. If stocks are fairly valued at 16 times earnings, and they're currently trading at 25 times earnings, they're roughly 56% overvalued. That means to get back to fair value, they'd need to fall about 36%. Even if the companies keep growing earnings at 5% per year, it could take 7 or 8 years just to grow into current valuations without the stock price going up at all. So you're taking the risk of a 30 to 40% decline to earn maybe 5% per year if everything goes well. Does that sound like a good trade to you? Because it doesn't to me. Compare that to what I can earn on Treasury bills, 4 to 5% with essentially zero risk. The U.S. government isn't going to default. I'll get my money back. I can sleep at night. And when stocks eventually come down to reasonable prices, I'll have capital ready to deploy. This is what I mean by opportunity cost. Every dollar I invest in overvalued stocks is a dollar I won't have available when better opportunities arise. And I've learned that good opportunities always arise. Always. The market goes through cycles. Pessimism follows optimism as surely as night follows day. When everyone is fearful, that's when you want to be greedy. When everyone is greedy, like they are now, that's when you want to be fearful. I know this goes against every instinct you have right now. You see your friends making money. You see your neighbors buying new cars with their stock market gains. You see financial television celebrating new all-time highs. You feel like you're missing out. You feel like you're being too conservative. But let me ask you this. Would you rather feel like you're missing out on some gains now or feel like you lost half your wealth later? Because those are often the choices. The market rarely lets you have it both ways. Here's another thing people don't talk about enough: psychological damage from big losses. I've seen investors who lost 70 or 80% of their wealth in 2000 or 2008. Many of them never came back to the market. They were so scared by the experience that they stayed in cash for the next decade and missed the entire recovery. The financial loss was bad enough. The psychological damage was worse. That's what I'm trying to help you avoid. It's not just about the money. It's about keeping your composure, staying rational, being able to think clearly and act decisively when opportunities present themselves. If you lose half your net worth casing a bubble, you might not have the emotional fortitude to buy back in when prices are attractive. You'll be too scared, too traumatized. I've never had that problem because I've never let myself get into that position. I've never owned anything at a price that would devastate me if it fell. I've always maintained a margin of safety. I've always been conservative in my assumptions, and that's allowed me to stay in the game for 7 decades without ever having a year where Berkshire lost more than we could handle. That's the real secret to long-term investing success. It's not about hitting home runs. It's about not striking out. It's about staying in the game long enough for compounding to work its magic. And compounding only works if you protect your capital. If you compound at 20% per year, but then lose 50%, you've wiped out years of gains. But if you compound at 12% per year and never have a devastating loss, you'll end up far ahead over time. Let me give you another concrete example of why this matters. Take someone who invested $100,000 in the NASDAQ in August of 1999. At the peak in March 2000, that investment was worth roughly $135,000, a nice gain. But if they held on by October 2002, it was worth only about $34,000. They lost 75% of their peak value. Now, how long did it take to get back to even? The NASDAQ didn't recover its March 2000 peak until April 2015. 15 years. That's 15 years of earning zero return while taking all the risk of owning stocks. But it gets worse. Because of inflation, the purchasing power of that money fell by roughly 35% over those 15 years. So in real terms, they still weren't even close to breaking even. Meanwhile, someone who sold in 1999 sat in Treasury bills earning 5% and then bought back in during 2002 or 2003 would have made an absolute fortune. They would have earned 5% per year in safety while everyone else lost money. Then they would have bought back in at 70% discounts and ridden the entire next bull market up. That's the power of being willing to sit on the sidelines when prices don't make sense. You don't just avoid the losses. You position yourself to take advantage of the opportunities those losses create. This is what I'm doing right now with Berkshire's cash. I'm not earning much on it, but I'm preserving capital. And when the inevitable correction comes, when fear replaces greed, when everyone is desperate to sell, I'll be the one buying. I'll get to pick up wonderful businesses at fire sale prices while everyone else is panicking. That's happened in every major downturn in my lifetime. It happened in 1973 and 1974. It happened in 2000 through 2002. It happened in 2008 and 2009. It happened briefly in March 2020. And it will happen again. The only question is when. Now, I want to address something I hear a lot. People tell me that they're young, that they have time to recover from losses, that they should be aggressive. And there's some truth to that. If you're 25 years old with decades ahead of you, you can afford to take more risk than someone who's 65 and retired. But here's what I tell young people. Yes, you have time, but that's even more reason to be smart about valuations. Because if you invest at terrible prices today and spend the next 10 years earning nothing, you've wasted a decade of compounding. Those are years you'll never get back. Whereas if you're patient, wait for better prices, and then invest at reasonable valuations, you'll compound from a much better starting point. Think about it this way. Would you rather invest $100,000 today at 25 times earnings and earn 5% per year for the next decade? Or invest $100,000 3 years from now at 15 times earnings and earn 12% per year for the following decade? The second scenario gives you far better results even though you started later. Time is an asset, but only if you use it wisely. Compounding at mediocre rates from expensive prices is not using your time wisely. And here's something else young investors need to understand. The habits you form now will stay with you for life. If you learn to chase momentum, to buy what's going up, to ignore valuations, to use leverage, those habits will hurt you again and again throughout your career. But if you learn to be patient, to focus on fundamentals, to demand a margin of safety, to think independently, those habits will serve you forever. I learned these principles in my 20s. They've guided every decision I've made for 70 years. They worked in the 1950s when I was getting started. They worked in the 1970s when inflation was raging. They worked in the 1980s when everyone said manufacturing was dead. They worked through every boom and bust since then. And they'll keep working because they're based on sound principles, not on market timing or predicting the future. So whether you're 25 or 65, the principles are the same. Understand what you own. Pay a fair price. Maintain a margin of safety. Think long-term. Don't use leverage. Don't panic. Be greedy when others are fearful and fearful when others are greedy. Right now, others are greedy, very greedy. That makes me fearful, very fearful. Look, I understand the temptation, I really do. Watching stocks go up every day is intoxicating. Seeing your account balance grow feels wonderful. Reading about people who made millions on NVIDIA or Tesla or whatever the hot stock of the moment makes you want to join the party. But I've been to enough parties to know how they end. The music stops, the lights come on, and you realize you're standing there with an empty wallet wondering what happened. I'd rather miss the party and keep my capital intact. I'd rather be the boring old guy sitting on cash while everyone else is having fun. Because I know that sooner or later, after the party's over, people are going to need capital. And I'll have it. And I'll be able to put it to work at prices that actually make sense. That's the position I want to be in. That's the position you should want to be in too. Not caught up in the excitement. Not worried about missing out. Not checking your portfolio every 5 minutes hoping it went up another 2%. Instead, sleeping soundly at night knowing your capital is safe. Knowing you haven't taken risks you can't afford. Knowing that when opportunity knocks, you'll be ready to answer the door. That's what real investing looks like. It's not exciting. It's not glamorous. It's not going to make you feel like a genius at cocktail parties. But it works. It's worked for me for 7 decades. And it will work for you too if you let it.